Hi everyone, welcome to today's webinar. My name is Fawad Razaqzada, market analyst with Think Markets. I'm based in London. Also in the room is my colleague Victor, who is more of a macro analyst than myself and always has interesting perspectives on the markets. Obviously, this webinar is live, but if you're watching it, if you're watching the recording of it on YouTube or elsewhere, please consider joining us live for the next one, as you will have the opportunity to ask us questions about any tradable markets with Think Markets. But if you are watching it on YouTube, please make sure you like and share, as this will encourage us to provide more content like this. For those of you who have joined us, welcome to the webinar. Please help us by writing comments and questions in the chat box, and we will be more than happy to provide analysis on any particular market that you are after. Before we proceed to the live charts, please have a read through the risk warning, which is coming up right now, and then we will begin the bulk of the webinar. But I'm going to read the first paragraph with you. These webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So just to remind you guys, this webinar is mostly about charts and technical analysis than fundamentals, although we do touch on fundamentals as well. And it happens every Tuesday at 11:30 London time, okay? So please make sure you join us for the next one if you're watching a recording of this on webinar, on YouTube. Now, what's driving the markets? Well, overall, it's still the optimism about the global economies reopening because of the vaccine rollouts. Stock markets did wobble a little bit in the last couple of weeks, but start of this week we've seen a nice rebound. Not too sure if that will hold for too long, but we'll go through the stock markets briefly later on. Inflation is a key concern at the moment. We've seen yields rise across the board, especially in the US, with the 10-year US yield rising to 1.5%, which is the same amount as the S&P 500's dividend yield, which makes us wonder whether, for investors, is it safer to hold the stocks or go into the bond markets and get the same expected return? In terms of this week, we have a couple of macro events, most notably the non-farm payrolls on Friday and the OPEC Plus meeting, which is on Thursday, are among the key events happening this week. So there will be bouts of volatility here and there because of macro events that will happen this week. Now let's go straight to the charts. And shall we start, Victor, with the FX markets, or should we go to the equity markets first? Tell you what, let me just load up the chart.
Sure. Let's start with FX.
Yeah. Before we go,
Dixie open.
Let me just share this chart of the 10-year US bond yields. So as you can see, bond yields have been going up quite rapidly in recent weeks. And this is obviously in response to investors expecting the Fed and other major central banks to kind of taper their QE purchases because of expectations that the global economy is going to recover and that this will cause inflation. Now, when inflation rises, central banks typically tighten their policies, right? And that's what the market is kind of pricing in at the moment.
Right. I just wanted to add some color here that while many people want the Fed to be the one who's driving yields, in reality, it's the market. And the moment when the market anticipates that bonds are trading at disproportionate values and they're paying and they need to get extra yield in order to justify for themselves to buy the bonds. Basically, interest rates rise, and this is what has been going on, particularly in the US and the UK. And in the UK, over the past, well, let's say, month. It started
since the turn of the year,
at
I
the
think.
beginning of yeah, you could say that, yeah. So, but yeah, the more pronounced increase in yields has happened over the past month, and hence the dollar and the British pound have been outperforming over the past week. However, the dollar has taken the crown, and it has rallied against the British pound as well. It's close to testing this previous highs in the Dixie around 91.50, 70 area. So it would be wise for traders to watch these levels, and provided that we see a break, we could see some follow through.
Yeah, so that's the key area of resistance, or prior resistance, I should say, for the dollar index. And here we've seen the dollar index bounce from here in September, before breaking down in November, came back up to retest that provided some resistance. I was expecting the dollar index to go on and take out the prior lows and possibly reach down to the 2018 low as well. I mean, it could have still happened, but the recent price action has been somewhat bullish. We're above the bearish trend line now. So the bearish trend for the dollar has weakened, if anything, right? So it might not be a complete trend reversal yet, because we haven't had a distinct higher high, but the underlying trend, which was bearish, this trend has weakened. So you have to, if you're still bearish on the dollar, you kind of have to trade more from a level to the next level, rather than kind of going for swing trades and hoping that the dollar will sell off massively. I mean, it still could happen, but given how the dollar has consolidated in this area since the early December, which is now what, 3 months, you should be expecting the downside for the dollar to be limited when you trade any major currency pairs. So that's the key takeaway point from this. Obviously, if it now starts to go above this shaded region, then that would complicate the pictures. Now, the dollar index is a inverse chart of the euro dollar mostly. So let's jump straight to the euro dollar. And as you can see, the euro dollar has broken its corresponding trend line as well. Okay, but it's testing the key support level around 120. So what I'm looking for now, what I'm looking for next is, will it break 120? If it breaks 120 and holds below it, then this will be a genuine break of the trend line, because as you can see from the previous trend lines, we have had occasions where the trend line was broken. For example, this black trend line here, we spent a number of days below it, but the trend was reclaimed and subsequently we pushed higher. So this could be another such occasions, for example, like here, when we saw the trend break for like a day or so before reclaiming it and then pushing higher. Again, over here, same thing happened. So just because the trend has broken, don't assume that the euro is going to sell off, especially because, you know, contrary to expectations, the ECB actually reduced its bond purchases. Was it reduced, Victor? Because I read somewhere that they reduced their PEP purchases last week, which should be positive for the euro, right?
Well, they reduced it due to redemptions, however.
Oh, okay.
So the number was lower, but that was adjusted for redemptions. This wasn't actually a big news item. It was for some people who said, "Oh, you see, the the pace has lowered, so the euro should go higher, and
Yeah.
it went lower.
Yeah.
So be careful with the noise, guys.
Yeah.
Always.
So going back to the chart of euro dollar again. Right now it looks bearish, doesn't it? Because it's broken the trend line. It's created this false breakout above all resistance. When this happened on that particular day, I was quite bullish on this. I said, okay, we've broken this resistance. It should now go on and take a
you were bullish until the daily candle closed.
Yeah, look how it closed then. It closed back within the range, and then on the next day we saw downside follow through. So now it's kind of done its objective in terms of short-term objective, coming back down to retest that 120 handle, 120 being a key level of prior resistance and support, not to mention a very important, psychologically important level. And it's bounced there again today, as you can see by the wick of the candle. But
yeah, to be honest,
doesn't
this
mean
might be another range trade. Let's see.
So in terms of resistance, now this right here, this level at 120.25-ish is very important, because as you can see over the last couple of days, this level has provided some support, but today we're below it, retesting it now. So let's see where the euro dollar closes today. If it closes below 120-ish, I think that would be really bearish. That could lead to a drop to 118 in the coming days, where we have the 200-day moving average converging with prior lows. Whereas if we get a nice hammer candle, then this once again raises the possibility of price making another push to the upside. I personally am not too sure in terms of which direction it will go. So as a technical analyst, I would like to see what price does first before making my mind up. Now, obviously, this being a non-farm payrolls week, you will tend to see range band market action. It's very typical for a non-farm payrolls week. People are watching data closely now because everyone is speculating about the timing of the Fed's next move, right? And everyone knows that they're probably done with providing additional measures to support the recovery. So the next likely move from the Fed and other major central banks are likely to be reduction in QE purchases. And when will that happen? It is when the economy is starting to overheat, when we see signs of inflation rising. And so incoming macro data is going to be very important, as it will adjust as investors' expectations about the health of the world's largest economy, and therefore expectations about the future path of monetary policy. So incoming macro data is going to be very important for the major currency pairs. I say that data is always important, but over the last year or so, because of the pandemic, no one has really cared about macro data because everyone knows that things have gone to everything's been impacted by the pandemic. And
speaking about data, I can only add that the dollar has also been boosted by a higher pace of vaccination in the US as well as in the UK. In fact, Europe is still lagging behind badly, and the likelihood of the European economy reopening anytime soon is actually slim. Hello, Fawad, you're probably muted. I don't hear you. Yeah, you are muted, definitely. Yeah, now you are unmuted.
Okay, can you hear me now?
Yeah.
Yeah, sorry, I think there was a problem with my mic. It got disconnected. Thanks for
no problem.
Yeah. So yeah, you mentioned European countries. They've had their fair share of trouble with the vaccinations. That's why the pound has been the stronger performer out of the two major currencies. You can see the euro pound has been declining in a strong bearish trend. We did see a bounce last week, but it looks like that bearish trend has now resumed because this 87 level on the euro pound has turned into resistance, having previously served as support in the past. So it looks like the euro pound could be heading down to 85 next, and possibly 83, which is this low here that was hit in February 2020. That could be the next downside target for the euro pound. So if you're not too sure about the direction of the US dollar, I would recommend you look at currency crosses, because some of them are trending quite nicely, such as the euro pound. There are a couple of other ones that we could go through. For example, the euro Swiss is making a comeback. As you can see, euro Swiss has been on a tear, really. This is the weekly chart. You can see the euro Swiss. Actually, let me go to the monthly chart. Okay, monthly chart. Euro Swiss has been in a tight consolidation for many months, and now it's kind of broken above the resistance range after holding its own above the long-term bullish trend line. So zooming into the weekly, you can see that zone very cleanly. Nice breakout. Last week we closed positive, so this looks like a bullish trend has resumed for the euro Swiss. So what I'm looking for next is a possibility of price to dip into this former resistance area, which could then turn into support, leading to a nice bounce. Either that, or we see a period of consolidation around where we are, for price to form a pennant formation, like a triangle or whatever, and then a break above that triangle, or a bull flag, or whatever other continuation patterns it makes here. If we move above that, then that could signal the resumption of the bullish trend. So keep an eye on the currency crosses if you're not too sure about the major currency pairs. But going back to the major currencies and looking at the pound against the dollar, the pound has weakened for the last several days, but the underlying trend is bullish. Price is still within this long-term bull channel. Let me just clear this chart up a little bit because it's starting to look a little bit messy. I don't like my charts when they're too messy. So as you can see, I've got a few other things left here. The 2020 high is here. The 2019 high, this level right here. So those are the levels that could potentially provide support if we see a deep pullback. But are we going to see a deep pullback? I'm not so sure. The 21-day exponential is still rising, and this moving average has provided consistent support for the pound dollar, because when the trend is strong, you will get to see lots of support from the 21-day exponential, rather than deep retracements to the 200-day or the 50-day moving average. So around the 21-day exponential is when you should be expecting the depths to be supported. And right now, we are testing the 21-day exponential once again. And the reason I've shaded this region in gray, it's because this was the last down candle prior to the move up that led to a sharp rally, right? So in other words, it's like a demand zone. It must have been during that down move that people bought heavily, causing price to react. Right. So now that we are testing that demand zone once again, I'm expecting to see a bounce of some sort. However, if this shaded region breaks, then you would have to consider the alternative scenario, which would be bearish, because previously people were buying here. If now that buying turns into selling, then at the very least, I would expect a move down to the bullish trend line, which comes in all the way at 137-ish, 137.50, depending on how fast it gets there. But even if it gets there, the longer term trend would not end until we form a distinct lower low. Now, the last significant low was at 135.67, this level here. So for as long as that level holds, the path of least resistance from a longer term point of view would still remain to the upside, regardless of what price does in the interim. But ideally, what you would like to see next is for price to hold this area of support and create a nice hammer-like candle or another bullish-like candle before continuing higher. So that's what I'm expecting from the pound. And speaking of the pound, it's the UK budget review this week. And it's going to be in focus because whatever Chancellor Rishi Sunak announces, this will impact the pound, especially if there are any surprises in the budget. So watch out for that. It's happening tomorrow, and therefore the pound could be could move sharply on the back of that.
Yeah, I think that there are rumors that he's going to announce some tax action on wealthier individuals. So let's see how that goes, whether it spreads into corporate tax hikes for certain companies that haven't been affected by the pandemic.
Yeah, absolutely. So very important. Let's have a look at a few other major currencies and then we'll move on. Okay, the Aussie dollar is bouncing nicely today after. You remember what I was talking about, the euro dollar breaking its bullish trend line, trapping the bears and whatnot. It could be the same could be happening for the Aussie dollar here. At the back end of last week, it looked really bearish after creating this long or rather large red candle, or black in this case, closing below the trend line. But look, at the start of this week, it's kind of reclaimed that trend. So keep an eye on this. If it now starts to move back above this region here, which was prior resistance, if it reclaims this zone as well, then what you could do is you could look for bullish trades in the subsequent days on the rounded retest of the zone to take us back towards the top of the recent range. So keep an eye on the Aussie around this area. Obviously, if it starts to roll over from here, the alternative scenario would be this area turning to resistance, and if that happens, what I want to see is I want to see price break through this low here, and then any rebound attempt could be sold, leading to a nice drop in the days to come. So that would be the bearish scenario. So a lot depends on what happens around this shaded region. So I want to see what happens rather than kind of preempt it, right? So for the bearish scenario, I'd like to see this low break, and then any round retest could provide a decent tradable opportunity on the short side. While for the bullish setup, although yesterday's candle is somewhat bullish and today's price action is still looking bullish, things could change later on in the day, right? So I'm not taking any chances on this. So therefore, I would like to see price go back above the zone, hold it, hold the breakout, and then on Wednesday or Thursday, if we see a return back to the zone, that level could be traded on the long side, I think, leading to a nice continuation higher. So those are the two scenarios that you could play out for, depending on how price action evolves this week. The Kiwi is also showing a similar picture, holding this trend line for the time being. But if it breaks through this low, then I think it's game over, because that's the last low prior to the latest rally. If it goes below that, it's bearish. So that's the line in the sand for me. And then a few currency crosses to keep an eye on. Euro yen is one of my favorites, along with pound yen. Pound yen is really strong, but even Euro yen is looking decent as well. Recently, it had formed this bull flag. It broke out of this and continued higher. I think because it's kind of tested the psychologically important 130 handle here, we've seen some profit taking. I didn't even quite get there, but just ahead of 130, price turned lower amid profit taking. But what's happened here is price is testing support. Price is testing support, and if it holds here, it's gonna.
It remains supported by by the dollar move to the upside as well. The dollar is pulling the Japanese yen lower across the board, and the crosses are basically following, despite the fact that the dollar is also rising against the euro.
Yeah. Sorry. I had to take my daughter. She came and asking for milk. Thanks for jumping in there, Victor. But yeah, she's back, so you can take over again.
No problem. The neighbors are doing a renovation, so we can switch. So basically, this trend for the euro Japanese yen is still supported. We could see another attempt to take out 130. We stopped just shy of it last time, and if the current support level holds, we could see another test of the 130 area. However, if we on the downside see a decline, then,
I think the construction work has started again for you. Sorry, I'll take over again. Sorry about that, guys. Working from home has its advantages, obviously, because you can work in your pajamas, but it also has its disadvantages as well, as you can see right now. But yeah, the euro yen is looking. We like to trade or focus on markets that are trending, because as traders, what you want to see is the you obviously you want volatility, but volatility in a particular direction makes it easier than a sideways market. Obviously, that depends on the type of trader you are. But for most people, following the trend is the easiest way, I think, to make money in these markets. And this is one of those markets where price is making higher highs and higher lows, price being above the 21-day exponential, above the 200-day moving average, above the bullish trend lines, and so on. So it's kind of, you just wait for the market to dip to support, and then you look for a bullish signal, and then you trade it long, and rinse and repeat. This is something I didn't do very well in my early years of trading, and I would always go against the trend for whatever reason. But the market is rising for a reason. People are not, big. The smart money that's moving the market, they're doing it for a reason, for a fundamental reason. So why do you want to fight that? It's beyond me. So always try to go with the trend until the charts tell you that trend has ended, in which case you could look for reversal trades. But right now, I don't think we've seen that reversal. So the path of least resistance for the euro yen remains to the upside. Let's go and have a look at the indices now, guys, because we are running out of time. So I'm going to start off by looking at the S&P 500. Now, S&P 500 held its bullish trend line following last week's dump. Okay, so that's a key point. It held its resistance. When it was falling towards the trend line, it held its support trend, I should have said. When it was falling towards the support trend, I drew a line here showing a potential resistance area. The market tested this level and it held before breaking through it on the very next day, on Monday, on the very next trading day, I should say. So this being a potential resistance on this day was no longer the case. So this could now turn into potential support, right? Because if a prior support breaks, you'd expect it to turn into resistance, which it did in this case, and then it was reclaimed on Monday. So if we retest this level again at some point today, I would expect to see a bounce of some sort. Around this area, somewhere around here actually, because this was the prior high. So already you can see the today's index futures bounce from this area. We also have the 21-day exponential as well. So far, equity markets have ignored the rising yields. Okay, in the US, yields have been rising, and people have been piling into stocks that are likely to do well during better economic times. So they call these stocks value stocks rather than growth stocks, which are dominated in the technology sector. But even the Nasdaq 100, which is a tech-heavy index, it too bounced back really nicely yesterday. Therefore, it looked quite bearish at one point last week when it formed this large bearish engulfing candle, and it looked like it was going to take out this prior low. It did briefly break through that on Friday, but then it closed higher, and then there was some follow through on the upside on Monday. Now today, index futures are down a little bit, but it's testing this prior resistance area. If it goes above that and holds, then this will probably signal that a new all-time high is coming. So if it goes above this red line, which was previously resistance, and where we have the 21-day exponential converging, then if it holds above that, bullish. While below it, there's still a possibility we may see the technology sector underperform because there's been a great rotation into value stocks from growth stocks. So that's something to watch out for. Now, finally, let's go and have a look at the gold and silver markets. Actually, we'll talk about crude oil as well. Now, gold has been going down because of rising yields. I'm going to show you a chart. Just 1 second. Oh, no, it's this one. So this is a chart of gold in candles format. The black and white candles is a chart of gold. On this chart, I have put the US. I've put the US 10-year bond yields, but I've inverted it. The reason I've inverted it is so that you can make it, you can compare it with gold and other markets more easily. Okay, so when bond yields rise, but because I've converted it, it shows as if they've fallen, right? When bond yields fall, when bond yields rise, gold tends to fall, which makes sense because rising yields increases the opportunity cost of holding assets that pay no interest or dividends, such as gold and silver. So if you're bullish on gold, you want to see bond yields fall again. Okay, so obviously this is inverted. I keep reminding you. When bond yields start to fall again, if they do, then gold could find support. Now, what about the S&P 500? Well, the S&P 500 has been tracking gold price, or rather, gold has been tracking the S&P 500 until November 2020. Since then, the two assets have diverged. So
yeah,
so
basically
far,
that's that coincides with the time the vaccines were announced.
Yeah.
Basically, now that we see light at the end of the tunnel, investors are not that there is not that much appetite to hold gold to protect against the risk that the economy is not going to return to normalcy. Now it's kind of only matter of time, and at least we hope so. And the market certainly believes so. The attractiveness of gold has declined dramatically.
Yeah.
And personally, I don't see any reason for us to not to return to previous levels around 1500, 1400, etc. Simply because there are better opportunities to make money than hoarding gold in these times.
Yeah, I kind of concur with that view because for those of you who know me, I have been quite bullish on gold for many years, and now that things have started to change, although in the very long term, I maintain my view that gold will go up, but right now investors are finding better opportunities elsewhere, as Victor mentioned. So gold is being sold as a result of that. Now, at what point will we turn bullish on gold? Say something happens from a macro point of view that causes yields to drop, or otherwise increases haven demand for gold. Well, for me, it will be if and when gold goes above its most recent high. The most recent high comes in at 1816. So for me to turn bullish, gold will have to reclaim that level, because if it reclaims that level, it will have also reclaimed the long-term support area around 1800 and broken a few short-term resistance levels in the interim as well. So unless that level is reclaimed now, there's no reason for me to be bullish tactically or technically on gold. Indeed, resistance being provided by these areas here. These levels have already been retested actually. Yesterday on Monday, price came all the way up to retest this area, this level, which was previously support. Didn't quite get there before it started to sell off. And in any case, those are the key areas of resistance now to watch on the upside. So if we do get a pullback, then I would expect gold to turn lower from these levels. Obviously, if it doesn't, then you'd have to consider the alternative scenario, which is bullish, right? But we will cross that bridge if and when we get there. But as Victor mentioned, what was the level you mentioned as your downside target?
Well, I'm thinking that we could test the 1500 and 1400 lows. If you move to a weekly chart, perhaps it's going to become clearer with some more, yeah, basically. The breakout for me happened, the big breakout happened around 1400 the first time, just below it, all right, in that 1380, 1400 area. Yeah, 1354.
That would be a massive move if we were to get there. A massive move.
Yeah, well, happened once before.
Yeah.
Back in 2012, well, 11 really.
Yeah. Obviously, there's an alternative view as well. This falling wedge pattern, I can get rid of this because it didn't really break to the upside, as you can see. I can redraw it like this. The alternative view that I'm about to mention is this candle right here, which is the last red candle or black candle, a down candle basically, before the price of gold went up. It was in this downward move that people started to buy gold heavily that caused this breakout. It's a demand zone. So if you're into demand and supply kind of trading, this is where gold should bounce from, right? Because it was a big breakout area. So, and also, let's not forget, yes, gold is looking really bearish right now. It's not even pulled back to the relatively shallow 38.2% Fibonacci retracement against its highs, against its all-time highs yet. So yes, in nominal terms, it's dropped quite significantly, but in percentage terms, it hasn't dropped that much since bottoming out in 2015. and hitting an all-time high in 2020. So what you'd like to see from a bullish point of view, from a long-term bullish point of view, is for price to form support around the 38.2 February trace and then break out to the upside again. That's the ideal scenario that one should be looking for. I've just drawn the ABCD kind of projection based on prior swings. It projects a point D around this area, around 1657. Doesn't necessarily mean it will get there, but it's one of the projection tools that traders sometimes use to predict where price is most likely to go down to. But more to the point, I wanted to highlight this down candle prior to the big move up, because that was the last demand zone. So there is a possibility it could find unexpected support around there, right? We have to say unexpected because right now gold is not looking very strong. If it does find some unexpected support there, then what I would like to see, as I mentioned on the daily, is a break above the most recent highs. We have run out of time, guys. I can't see any questions. Let me see the other chat box to see if there are any questions. If no questions, then and if Victor, you don't have anything else to add, then we can end the webinar.
I don't think so. Yeah. We perhaps didn't discuss oil, but
oh yes, oil. Yeah, let's very quickly discuss oil. Brent here.
Yeah.
Daily chart showing a strong bullish trend. It has come off the highs ahead of the OPEC meeting, which is happening on Thursday. Now, there's a bit of dilemma for the OPEC, isn't there? I mean, if they are to kind of, reduce the current supply restrictions, if they do it aggressively, then that's gonna cause downward pressure on oil prices. That's what they don't want to do that. Equally, if they continue to restrict supply, they're going to lose market share, and Russia is not very happy about that. Saudi Arabia is willing to do that, but if the rest of the OPEC group they don't agree to it, or OPEC plus I should say, then it's very unlikely that we will see the supply restrictions being extended. So I reckon supply restrictions will be relaxed as planned, but it's not going to be too significant to cause prices to drop sharply. That's my view. I could be wrong, but yeah.
Yeah, well, it depends on how much this is priced into the market, and that is yet something that we have to wait a little bit to see.
Yeah, I reckon 70 is a key level for Brent crude, because that's around where oil was trading before the pandemic hit. So I think it's possible we, given the ongoing supply restrictions from the OPEC Plus group and expectations about demand recovering, that prices could recover to around $70 per barrel. But beyond that, I just can't see how oil can go beyond that, or significantly beyond that. I think from around where we are, it's more likely that we'll see a $5 drop than a $10 drop than a $10 rally. Put it that way. I could be wrong, of course, but
yeah.
Oil has done its kind of objective, the OPEC-driven objective, which was to lift oil prices from around $20 or $30 area that was hit around the height of the pandemic. It's kind of doubled since then, right? So the OPEC, they have achieved their objective, and so with oil prices being at these levels, also you have to consider the fact that there'll be lots of non-OPEC suppliers like US shale producers who will be willing to ramp up production at these levels because it will be profitable to do so. So in the coming months, I think supply of oil is going to increase, and that should put downward pressure on oil prices. So I'm not very bullish on oil price. I do think oil price will go a little bit higher from here, and possibly the OPEC is going to move prices on Thursday to the upside. But yeah, as I keep mentioning, I longer term, I don't think oil will go significantly higher from around current levels. All right, guys, let's end the webinar. Thank you so much for joining us. I hope you found this useful. If you've watched this on YouTube or elsewhere, please make sure to join us again next week. And by joining us live, you will have the opportunity to ask us any questions about any tradable markets with Think Markets. And yeah, we like these webinars to be as interactive as possible, so we do encourage you to join us live. But please do like and share this video, because this will encourage us to provide more content like this. Take care, and we'll speak to you. Oh, before I go, we do have a webinar on Friday. Every first Friday of the month, we have the non-farm payrolls preview webinar, and this is happening at 11:30 London time. This is the link to find the webinars page, or if you don't know the link, just go to the homepage, thinkmarkets.com, and then go to market analysis, hover over live webinars, and here you have all our scheduled webinars listed, and then you can click on the register button to register to be able to enter these webinars. So the next webinar is going to be on Friday, 11:30 London time, and it's going to be a non-farm payrolls preview webinar, which is slightly different format to the live market analysis series that we have going. So the live market analysis series happens every Tuesday, and this will be the format of it. But the non-farm payrolls is slightly different, and I hope you can join us for that one. Now, take care. We'll speak to you soon.
Take care, guys.